Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Kathryn Young, Head of Investments at Cambooya. Kathryn, welcome.
Hi, Alex. Thanks for having me.
So I thought we should start off with what Cambooya is, maybe give a bit of background to the listeners about what it actually does and its objectives.
Yeah, sure. Absolutely. So Cambooya is a family office. It's a single family office in that it services people from a single family. It's quite mature. It's been around since the 80s. So that's quite mature as family offices go, especially in Australia. So what that means is that we do have several generations that we service, several generations of the family that we service. So we call it a single family office, and it is, but there are multiple family groups within the family office that we work with. And we, as a family office, we service their needs quite holistically. So we manage their investments, or we advise them on their investments. We also do their tax and accounting work. We help to manage the foundations that have been part of the family legacy for quite a long time. We help them with their IT needs. We do quite a lot of things for them.
So I guess family offices are always very interesting to people. And I think maybe part of it is because the wealth that's come behind them. Also, how they invest is quite opaque. What are the unique pieces of a family office that you would say maybe differs to a particular institutional investor that would see, such as a super fund?
Sure. So I think the first thing to say about family office as a space, which I'm sure most people will understand, is that it's extremely hard to generalize about because family offices are, they really run the gamut, which makes sense because they're, typically small organizations that are working with a single family. And so it makes sense they would be very different because they're very focused on that specific family. In general, I would say that you can classify family offices by sort of their age and whether or not there has been a wealth transfer. So for a family office like Cambooya, it's quite mature. There has been a wealth transfer. There's actually been multiple, really. So that makes it more institutional in its approach and in its style than many family offices probably would be. For a family office like ours that is more on that institutional end, I would say the key differences between us and maybe an industry fund, a small industry fund or something, would be that we would tend to be, we're much less constrained. So much less constrained by regulation, less constrained by fees, less constrained by liquidity. Those things, all make a really big difference. And I think as part of an outcropping of that, we tend to be much more concentrated. So concentrated in terms of asset allocation to asset classes, but also concentrated within asset classes and, to specific investments. So that concentration is a big deal. We would probably also have a lot more illiquidity in the portfolio than a super fund or an industry fund would have. And, I would say that we have the luxury of being able to manage with a really genuinely long-term mindset because we don't have the constraints around cash flow sort of coming in and out, and we don't have the constraints around regulation and peer sensitivity. So that, that allows us to be probably more long-term in our average decision-making.
Is it fair to say that a typical family office, is very much absolute return focused?
Yes, I do think that's fair to say, actually. I mean, I think I think it is fair to say, and it has a lot to do with that lack of constraint, because when you are, when we don't have so many peer sensitivities, we don't need to be focused on a benchmark. It means that sort of the world is our oyster in terms of investments. We're just very unconstrained on the opportunity set. And so naturally, when you are, I think it's natural when you're that unconstrained that you think of everything sort of relative to whatever your objective is. And typically that objective tends to be structured in a CPI plus sort of way. That's how ours are focused or structured. And so that means is that you have to have something to compare, to rank order or to classify investment opportunities as better or worse. And so you use your own objective to do that. And so I think you become absolute return oriented because of that lack of constraint.
And likewise, how does the family, I know it's obviously each family has a very different background. What's sort of the thinking behind the willingness to take risk and the sensitivity to losing money?
Yeah, that's a really good question because I think when I moved into family office, everyone kept telling me the old adage in family offices, don't lose money. And I think that's true because that's human nature, right? Nobody likes to lose money. So I think that is true to some extent, but I think it's actually not as true as people think. We are absolute return oriented in our approach. But like I said, I think that comes it has more to do with the lack of constraint and opportunity set and how you manage that than it does with an actual aversion to losing money, because I think that it's different than people think for a few reasons. Number one, if you're working with a family office where the person who made that money or who grew the wealth in the first place is still controlling the investments, that person probably has a pretty high risk tolerance because they probably had to take some risk to make the money in the first place. So their nature is comfortable with risk, I think. And the other thing is that, these people, many, even if you didn't make the money, they understand that they have a capacity to take risks. They understand that if they, make a decision and it doesn't work out, they're still going to be able to put food on the table. So that capacity engenders risk taking. And I think, there's also, they don't have as many liquidity concerns. That also enables you to take risk. And the other thing is that if you inherited the wealth, then you are probably part of a growing family. And probably that pool of money that you inherited needs to support a growing family. And so you understand that not doing anything is also a risk because time and most likely inflation will cause you to lose money anyways. I think it's human nature to not want to lose money, but I think that in family office, there's plenty of risk appetite as well.
So you mentioned about being unconstrained. Now, obviously, a family office has limited resources. How do you think about the resourcing in terms of the amount of opportunities that are out there? You can pretty much go anywhere. How do you sort of balance that out?
Yeah, that's another interesting point, I think, because the world is you're spoiled for choice, right? You're spoiled for choice, and that is a really lucky position to be in, but it does leave you having difficult decisions to make sort of all the time because you have so many things to evaluate. You also have, typically you have a set of money, but it doesn't, you don't have the level of resourcing that you would at a super fund or an industry fund, right? You don't want to hold that, have your fixed cost base be that high for it. So you do have to think carefully about the resources that you have. It's very interesting because you get to have a really blank slate about what kind of resources should you have in-house, what kind of resources should you leave external. Do you have to pay for it if it's external, or is there some way that you can use your network to get what you need? So these resourcing decisions are important for every organization, of course, but I think that they are really interesting in the family office space. And so I think that it's extremely difficult to generalize about how a family office structures its team, structures its resources, and uses consultants, because that really would be very specific to the office, to the family, and what exactly they're trying to achieve and how they're trying to get there. Some have big private equity teams in-house, others have pretty sizable property teams in-house and outsource more equity management, whereas others really prefer to pick stocks and outsource the rest of it. So it's very different to each family office.
Can you give a bit of color in terms of what specifically that Cambooya does internally versus externally, or with the use of a consultant?
Yeah, sure. So we prefer to have breadth internally and to and to source depth externally. So we have, our internal team is 5 people, and we have, each of those has a wide, none of us have a really specific specialty. So, I probably have, my background is in manager research, and that might be the most specialized of anyone on the team. And that's just, as one little area of investments, and that covers a broad variety of asset classes. So I think, we have chosen to have breadth so that we can cover a lot of ground in terms of types of investment strategies and asset classes. We can also, work on asset allocation itself, and the sort of the more personal advice side of working in a family office. So we have breadth. We can cover, property, private equity, credit, equities, alternatives in-house. But then we use experts, we use advisors to sort of go deeper into those areas and bring us ideas. So we use experts for idea generation a lot, and then we use the internal team to filter that. Whereas I think other offices that choose to sort of swing the bat in a specific asset class would choose to have depth in-house.
Mm-hmm. I'm curious in terms of how institutional are you in the thinking? Do you have an investment committee that sort of helps to set the asset allocation, and then you guys are working? How does it sort of build up?
Yeah. Governance structures are another really big, interesting point in family office, and those absolutely run the gamut as well. We do have an investment committee that is external. They're external independent experts. And so they don't make the final decision for any of the investments made by the family, but they advise the family. So they are sort of a check on us as the internal investment team. We don't report to them, but we run everything, that we think is a good idea past them, and they will endorse that or maybe send it back for they think that we should investigate this area or that area a little bit more. But that, they play a very important role because they help the family get comfortable. I think that the internal team, it remains strong and focused on the right areas, but they also, again, they help us get more depth in specific areas because those investment committee members all have, different backgrounds. And so they bring depth in different areas to the equation.
As we think about sort of risk and you sort of talk about these concentrated bets, is it fair to surmise that the family office can have sort of more of a barbell approach to the way that it invests, which is quite different or distinct to a super fund where their balanced portfolio is across all asset classes and it's sort of almost an equal weighted risk across everything, as opposed to maybe a family office that may have some very low risk, maybe cash or fixed income, and then having sort of really strategic bets in their thinking? Is that fair to...
Yeah, look, I think I think that you do end up with a lot of that. And it makes sense because, again, when you come back to this absolute return objective, think about, how can we achieve that objective, or how could we maybe even do a little bit better than that objective? I think a barbell is a barbell strategy falls really naturally from that consideration. So you think, let's take a swing at this private equity, this venture capital, this property, this infrastructure, but let's keep this cash on hand to facilitate our capital calls, and let's, to facilitate any opportunities that we have along the way. So I think that balance of risk is just a natural, intuitive, logical way to approach it when you have the world as your opportunity set. I think it also helps you manage the time horizon part of the decision, because you have this capital, you're always trying to, you're thinking to yourself, is this a great opportunity, or is there going to be another one down the road? I mean, every investor faces that opportunity. But when you have this, I think it's especially acute when you have this absolute return orientation. So that, I think, again, it makes sense to hold a proportion, to have this barbell approach where you have a lot of liquidity on the other side, balancing that illiquidity, because it also helps you balance the idea about, will there be another great opportunity down the road?
Mm-hmm. Yeah, there seems to be a lot of pros in a family office, right? Being unconstrained, you don't have the pressure around liquidity that you need to have for a typical super fund. You've got risk tolerance that seems to be better. Are there potential cons alongside it in terms of maybe, a lot of these families have made money from one particular area, so they've got a very high bias, or maybe that's a large cornerstone to the portfolio, and then you've got to build out the rest of the portfolio alongside this piece. So what are the potential challenges rather than a con of running a family office?
Yeah, there are lots of pros, Alex. I got to say, there are lots of pros. As you say, I like to say it's intellectually satisfying being in family office because of this sort of, unconstrained nature of it. But there always is a challenge that comes alongside those fantastic pros. And I think the number one challenge is that you need, as a professional, as an investment professional, you need to ensure that you're really well aligned to the philosophy of the office, the leadership of the office, and the family. And when I say aligned, I mean aligned in terms of your philosophy, your investment philosophy, how you think it makes sense to make money. You would really want to be very well aligned on that. But also, just from a personality perspective, you need to make sure that the way that you make decisions, that you and the leadership of the family and the leadership of the office can work well together to make decisions. It's not that you make decisions the same way, but you need to be able to communicate clearly about that because it's a small organization typically. And because, the world is your oyster, you need to be able to make decisions quickly and filter quickly. So you need to be aligned in terms of philosophy and personality. And I think, the challenges that you mentioned there as possible challenges in terms of, there's already a lot going on in the portfolio that has to be managed. That actually happens a lot in family office portfolio construction. You have a single concentrated position that is illiquid or effectively illiquid. And so you have to manage the portfolio around that. That's a really common challenge. But I think that as long as you are aligned on investment philosophy and making decisions, that kind of stuff can always be dealt with. So that's the key thing is alignment and sort of trust and faith in the governance structures. The other thing I think as a professional that you want to be aware of going into family office is that it can be quite opaque. And so it can also be, both from the inside and from the outside. So, you can end up being really inwardly focused often as a family office because, you don't really have to ask, consult with anyone else if you don't want to. So you can end up being, pretty inwardly focused. So it's always important to keep your head on a swivel, to stay really active with your peer network. It's one of the great things is that, you're not competing with your peers. They can be a great resource. And so, you need to stay active, working with them and giving back to that network as well, and making sure that you really think deeply about what other people are doing and how you can potentially use that in your organization.
Just going back a little bit more specifically to the investments that you look at, you talk a lot about the family and making sure that you communicate and map back to the family's expectations and so forth. Do you feel that there's maybe a preference for less complex investments? There's a lot of new investment strategies that are coming out that are really quite complicated, that maybe are a little bit hard to explain, and the family prefers more simple real asset style investments or clearer strategies that they understand better. Do you find that that's potentially something that's part of the thinking?
Yes, I think that is one of those adages about family office that actually really is true in practice. I don't think that's a bad thing, I should say, but I do think that that is normal. First off, in the Australian context, many families made their money out of real assets. And so, that makes sense to them. Okay. So number one, that makes sense to them. They feel comfortable with it. They can wrap their arms around it. And that is completely rational, right? As an investor, it makes plenty of sense for you to invest more capital where you feel that you have, some sort of an informational advantage, or at a minimum that you feel you understand the risks that you're taking. So I think that it's really rational from that perspective. I also think that when you are in family office, and especially in those family offices where the person or the family that made the wealth continues to control the wealth, I think that they are acutely aware that they are now playing in a sphere. When they've gone into finance, they are now potentially playing in a sphere where they are, a small fish in a big pond, and they, are aware that they are, potentially easy marks. So I think that they do have a really strong tendency to avoid those things that seem excessively complex, or that they have a difficulty understanding, because it leaves them more vulnerable in terms of being taken advantage of in fees or what have you. So I think that actually is true, but that's okay. I don't think it's a terrible thing at all, as long as you're reasonably well diversified in terms of underlying risks. I think that's fine, and I don't think you need a hedge fundy type of strategy to make sure that you have diversification in terms of underlying risks.
It's a very interesting conversation around risk as well, because for a lot of these families that have built their wealth, they have had their team, their family running these businesses typically. And so they understand the risk that's there. They feel they can control it, as opposed to sort of the broader market risk, which is much more unconstrained. It's much harder for them to control. You've got to sort of trust somebody else to manage that risk. There's a bit of a disconnect there.
Yeah, I think that's right. I think lack of control or loss of control is different for everyone. And so I think, it's difficult for everyone, excuse me. And so, I think it's really, I think this actually gets back to, sort of our earlier point about, don't lose money. Is that the adage in family office? And I think that's, probably where that idea comes from, is that people, feel like, families are hesitant to take risks that they don't understand very well. It's not that they're hesitant to take risk. It's that they're hesitant to take risks that they don't understand, that they feel they can't control, because they are used to being able to sort of take a controlled risk, or, have more control over the outcome. So I think that's probably where that comes from. I think it also, there's all kinds of very interesting behavioral aspects to managing wealth in the family office space. And that is also one of them, because there's this control issue changes a lot, I think, after you've had a wealth transfer. I think that that control over the outcome tends to be more acute for someone who, built a business or made the wealth, as you say, but it fades as, the wealth is transferred to successive generations.
Mm-hmm. Let's take it a little bit more closer to today and to markets. One of the things that has become obviously quite prominent is currency. Australian dollar's been moving around quite a lot. How important is managing currency as part of your book?
It's actually really important. It's it's one of the bigger decisions that we make, and that I think everyone can appreciate that's been especially true lately over the past few months, as currency was just so volatile in March and April, in particular. I think it's challenging because everyone has to make a currency decision, but I think in our case, it is, it is quite complex, because we have so much illiquidity, and we do have quite a lot of illiquid offshore exposure. And those aren't, managed neatly in, tidy structures. So managing the currency exposure related to those really does fall on our plate. And so, having to, develop a process to manage that, and to, there's just so many elements in play constantly, because we have, commitments that we've made that will be called upon over, the coming years. And so we have to manage that liability, but we also, of course, have the assets of, investments that have been made over the years. And we have, the exposure in more liquid investments. So there's just a lot of different pieces of that puzzle, in play. And so it's just sort of it's an ongoing challenge for us, really, both to build the the process by which we manage it, and then also just technically to execute it. What is the best execution for that? So I won't say that we've solved that issue. Is just it's just constantly ongoing, really. And I find, the more that we talk to our peers about that, and try to gain insight from their experience, we find that everyone is doing it really, really differently. Mm-hmm. So.
And you talk about the volatility of late. That's created a lot of sort of maybe short-term opportunities in some cases, particularly in credit. It's one of them that's come up a lot. A lot of the super funds are talking about it. What are the sort of the shorter-term opportunities that are there, and how tactical can you be in sort of taking advantage of some of these?
Yeah. So we, I would say in terms of the opportunities that we see, it's right now, I think it's probably we're seeing the same ones as, industry funds. But we think that will probably change over time. We are also seeing, a lot of credit opportunities, or apparent opportunities anyways, are coming across the desk. We actually can be quite tactical because of this, we talked about earlier about the sort of barbell approach to portfolio management. And I would say that we are not really far down that line. We're, pretty structurally, we have a strategic asset allocation, and it's reasonably well balanced and diversified. So we're not, we don't really use a barbell, but we have really shored up liquidity in both in cash, and in sort of short duration credit, which, who knows how liquid that will be when you need it. But, we have shored up a little bit of a war chest so that we can be, I guess tactical. We would see that as not so much tactical as finding a good entry point for long-term opportunities, but nonetheless, we are, we have built in an ability to be able to do that. And we are certainly, eager to deploy that when good opportunities come up. The challenge that we have is like I said before, it's about determining whether or not the opportunities we're seeing now are the best that we're going to see. How much should we deploy there, and how much should we sort of hold on and wait for more? I think there's this sense that there's going to be this, I'm calling it this golden wave of private equity opportunities, as we move through this crisis, so we're just really grappling with, is that really the case or not? I think it's clear that there will be distress, through the economy especially as fiscal support, monetary support is unwound. But, the question is that going to be in areas that you really want to, that you really consider an opportunity? I think one thing that's interesting about this crisis, as everyone knows, is that, it's a lot more visible which sectors are going to be the most impaired. And so I think that means that, I'm not sure that means there will be this wave of opportunities that we're kind of hoping there will be.
Is that fair then to say that you're probably willing to sort of wait it out another year or so to sort of see how this current crisis sort of unravels, I guess?
Yes, I think that's right. I think that's one of the benefits of being in this space, is that you have the luxury of sitting on that cash and waiting. We don't have any, peer benchmarks we need to worry about. And, I think that nobody's, worried they won't be able to, put dinner on the table if we sit on some cash. So I think, we definitely have the luxury of doing that. And so we will, in this case, I think, we will, but we're just, I guess, keen to make sure, we stay active and vigilant to finding good opportunities. But I don't think, we think it's best to err on the side of waiting. Yeah.
And would that same thinking apply to sort of general equities in terms of valuations as to where they're at?
Yeah, look, we're just not even looking to listed equities for opportunities at this stage. We certainly, there might be more, but we're not, we took some opportunities in listed equities already, and so we were fortunate to be able to have the capital and the willingness to take some opportunities in March, when it seemed like they were there. So we've done that. But at this stage right now, we would agree with many market participants that listed equities are pretty expensive. So we're thinking elsewhere for opportunities.
Mm-hmm. And taking it back to the whole broader absolute return sort of approach that we talked at the start, what are you doing maybe potentially in that absolute returns investment space? There's a lot of strategies that operate there around sort of macro funds and some volatility style strategies. Do you look at that area as well?
We really don't. And I think we really don't. And I think this is an interesting area because family offices will be totally across the spectrum on this. I think, we have done some sort of, I'll call them, liquid alts or, hedge fund style strategies, which I guess would be less liquid, depending on how you use that term. But, we have done some of that stuff in the past, very little. We've been, modestly happy with it, I guess, for the most part. But we just kind of feel like, especially with regard to liquid alternatives, it just doesn't make much sense for us. They haven't really, many of them have disappointed. And for us, it just, I guess it gets a little bit back to this barbell that we keep talking about, sort of what's the point? I think many of those strategies are built to help with sequencing risk, and we don't really face that. And so I think, we're happy to just take risk, and we're not really necessarily looking to hedge that risk out. We can wear risk, and we're happy to do so where that makes sense. So I think that many of those strategies, as discussed, the complexity is, it's not prohibitive, but it's, we don't necessarily love it all the time. And so, and then what they've actually produced in many cases just hasn't really been anything that we need, to be quite honest. Now, that's not to say we never will. Certainly there are some excellent strategies out there, and we're always keeping one eye on them, but we're not that motivated, I guess.
Mm-hmm. Final question. You mentioned earlier about sort of working with other family offices, and there's a bit of a network there. Can you give a bit more context on what that looks like? Is that sort of sharing ideas from investment strategy ideas or investment particular projects that you like to look at together? What does that look like?
Well, that is a very good question, actually, because that sort of changes all the time, I guess. It just sort of depends. We do a lot of feeling each other out. We have a lot of coffees and kind of ask, what are you doing about this? And what are you doing about that? Everyone is very protective of privacy. So we're always kind of we're sort of tiptoeing, and then we tend to sort of settle on something that's like, oh yes, we're both sort of working on this problem together. We're both sort of working on this problem. We can help each other out. Or here's an opportunity that we think is great, and we'd love to have a co-investor, let's say. Those kinds of things. That's how that's how it tends to go. We sort of build up a relationship over time, and then as where we find out that we have commonalities or similar aims, then we can work together on those kinds of things. So it just sort of depends, because as we've discussed, every family office is quite different. So how we can help each other changes from office to office. So I will say one thing that is really one massive benefit we get from that peer network is on the softer side of things as well, in terms of like, how do you, less investment focused, and more focused on how do you sort of manage issues related to, family management and governance structures, and how do you, how do you deal maybe with aging family members that are, still in control, and, just kind of thornier issues, I guess, more qualitative issues that network is just really invaluable for as well.
Mm-hmm. All right. That's been a fantastic conversation. Thank you very much for your time today, Kathryn.
Yeah, absolutely, Alex. Thanks so much. Take care.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.